morning. I am Jai Kumar, Assistant Professor, Department of Management Studies, SNS College of Technology. Now I am going to explain the topic average rate of return. Average rate of return is a method used in capital budgeting to evaluate the profitability of an investment. It measures the average annual profit as a percentage of the initial or average investment. ARR is based on accounting profits rather than the cash flows. The formula which is used to calculate ARR is average annual profit divided by average investment into 100. It is simple and easy to understand and calculate. It considers the entire life of the project. However, it ignores the time value of money. The project is accepted if its ARR is higher than the required rate of return. So, the ARR concept framework focuses on evaluating the investment profitability using accounting profit. It starts with estimating total profits earned over the project's life. These profits are averaged to find the average annual profit. And the investment base is then determined. ARR is calculated by comparing the average profit with the investment. It helps in ranking and comparing different investment projects. The decision rule is to accept the projects with ARR above the target rate. The framework is simple, but ignores each cash flows, and time value of the money. The average rate of return is a capital budgeting technique used to measure the profitability of investment based on accounting profit. It is calculated by dividing the average annual profit by the average or initial investment and expressing it as a percentage. ARR helps managers evaluate and compare different projects easily. A project is considered acceptable if its ARR is higher than the required rate of return. However, it ignores the time value of money and is based on the accounting data rather than the cash flows. The formula which is used to calculate ARR is average annual profit divided by average investment into 100. Average annual profit is calculated by dividing the total profit over the project's life by number of years. Average investment is usually initial investment divided plus scrap value divided by 2. The result shows the percentage return expected from the investment. So I have given some of the real life case study, and now let us discuss about the ARR through the design thinking lens. The first step involved in the process is to empathize, which helps us to understand the investor's needs for simple and quick evaluation of project profitability. Second step is define. It helps us to identify the problem of selecting the profitability project using easily available accounting data. Third step is ideate, which uses ARR as a simple metric based on average profits to compare the alternatives. Fourth step is prototype, where it applies the ARR formula to different project scenarios for decision making. Fifth step is to test, that is to evaluate the results and check if ARR aligns with the expected returns and business goals. ARR makes decision making user friendly but may overlook deeper financial insights. It focuses on simplicity rather than accuracy in terms of the time value of the money. Thus, ARR is useful as an initial screening tool in design thinking approach. Now let us discuss about the advantages of ARR. It is simple and easy to understand and calculate. It uses the accounting data readily available from the financial statement. It considers the entire life of the project. It is useful for comparing the profitability of different projects. Next, let us discuss about the disadvantages of your ARR. It ignores the time value of the money. It is based on accounting profits, not on the actual cash flows. Does not consider the timing of returns. It may lead to incorrect decisions for long-term investment process. So to conclude, average rate of return is a simple and widely used method to evaluate the investment profitability. It helps in quick decision making using an accounting profit information. ARR is useful for comparing multiple projects in an easy manner. However, it ignores the time value of money and the cash flow considerations. Therefore, it is best used as a preliminary screening tool along with the other methods. So, with this conclusion, I like everyone I'd like to thank everyone for this wonderful opportunity. Thank you so much.